If your CPA told you this year that your income was too high for your Roth IRA contribution, you're not alone and you're not in serious trouble, but here's what catches most people off guard. The IRS charges a 6% penalty on that excess contribution every single year on the same dollars until you fix it. And they're not going to send you a letter. This is on you to catch and correct. And today I'll show you exactly how. I'm Andrew Rafal, founder of Bayntree Wealth Advisors, and we work with high income earners and business owners on exactly these kinds of retirement and tax planning situations. So let's get into it. Here's how this typically happens. You made your Roth IRA contribution thinking your income will be within the limits. Then a bonus came in, or RSUs vest, or business income runs higher than expected, and suddenly you're over the threshold. For 2025, if the income was above $165,000 as a single filer or $246,000 as joint, you can't contribute to your Roth IRA. And for 2026, those limits move up slightly. $168,000 for single and $252,000 if you're filing jointly. So that's good news if you're right on the edge here in 2026. But if you're already over for 2025, the IRS calls that an excess contribution, and it does not go away on its own. Remember, they're going to charge a 6% penalty on that amount, and that penalty repeats every year the money stays in the account. On a $7,000 contribution, that's $420 per year. Leave it in there for 3 years, and you've got over $1,200 in penalties for a problem that takes one conversation to fix. You have two options, and let's walk through both. Option one, remove the excess contribution. Here's how you do it. You take the original amount plus any earnings it generated while invested. The earnings are taxable though as income. So if you're under 59.5, they may also carry a 10% early withdrawal penalty. So timing matters. You want this done before your tax filing deadline, including any extension. That's the cleanest way to avoid the penalty from applying at all. Option two, and the one we see most often, is recharacterization. Instead of pulling the money out, you move the Roth contribution into your traditional IRA. The IRS treats it as if you made the traditional IRA contribution all along. So excess contribution problem is gone. From there, many high-income earners go one step further, converting that traditional IRA back into a Roth using what's called a backdoor Roth conversion. It's a strategy specifically built for people over the income limit every year. Before you go that route, there's one important thing to check first. If you already have money sitting in traditional IRAs, the pro rata rule applies. The IRS looks at all of your IRA dollars combined, not just the portion you recently moved. And that can create an unexpected tax bill on any recharacterization. And this is where we see people make a second mistake trying to fix the first one. So if you have the pre-existing traditional IRA balances, get this modeled before you do anything. So if this is your situation, don't panic. This is common and fixable. Decide whether removing the excess or recharacterizing makes more sense for you. If you have existing IRA balances, get a second set of eyes before converting anything and act before your filing deadline. The penalty clock, it doesn't wait. If this situation sounds familiar, or if you're not sure where you stand on retirement and taxes more broadly, we want you to take our free Retirement Readiness Assessment. It takes less than a minute, and it gives you a high-level view of your retirement readiness across income, investments, taxes, even healthcare, and just overall planning. The link is going to be right below this video. And if you found this to be helpful, hit the like button so more people can learn about these strategies. And remember to subscribe for our weekly retirement planning insights. We're going to see you in the next video. Thanks for watching. Happy planning, everyone.